If you run a business with employees, there is a strong possibility that something in your August payroll is going to be wrong. Not because you are careless, not because you have not been paying attention, but because HMRC confirmed a series of payroll changes in their June 2026 employer bulletin that most employers have not yet fully absorbed. Changes to how statutory sick pay works, changes to how benefits in kind are heading toward the payroll, a new HMRC contact exercise starting in August that will directly reach your employees, and a set of full payment submission errors that HMRC flagged as the most common compliance failures they are seeing across employer payrolls right now. Welcome back to HMRC Update. Today, this video is specifically for employers, payroll managers, and anyone responsible for running PAYE in a UK business. I want to go through exactly what HMRC confirmed in their June 2026 bulletin, what it means for your next payroll run, and the specific things you need to check before August arrives, because the employers who find these issues themselves are in a very different position from the ones HMRC finds them in first. If you are not subscribed to HMRC Update, please do that now and hit the bell. HMRC's employer bulletins are published quietly and rarely make headline news, but the compliance obligations inside them are real, and the enforcement activity that follows when they are missed is very much real as well. Subscribe. Let us get into it. I want to start with the change that has the most immediate operational impact on the largest number of employers, and that came into force on the 6th of April 2026, with implications that are still being worked through in payroll systems across the country. Statutory sick pay has undergone its most significant reform in over 4 decades. Up to the 5th of April 2026, the SSP framework had remained largely unchanged since its introduction in 1983, operating on 2 core principles: a 3-day waiting period before payment began and an earnings threshold that excluded many lower-paid workers. Both of those principles are now gone. As of the 6th of April 2026, statutory sick pay rules changed. The lower earnings limit has been removed, expanding SSP eligibility. SSP has also become payable from day 1 of sickness absence. Payments are now capped at the lower of 80% of earnings or the SSP flat rate. What that means in practice for your payroll is threefold. First, every employee who falls sick is now entitled to SSP from the first day of absence. There is no longer a 3-day waiting period during which you could legitimately pay nothing. An employee who called in sick on a Monday under the old rules would not have received SSP until Thursday. Under the new rules, Monday is day 1, and SSP is payable from it. If your payroll system, your sickness absence policy, or your line manager briefing still reference a 3-day waiting period, that information is wrong, and it is costing affected employees money they are legally entitled to. Second, the removal of the lower earnings limit means employees who previously earned too little to qualify for SSP now qualify. Under the old framework, an employee needed to earn at least £123 per week, the lower earnings limit, to be eligible. That excluded a very large number of part-time workers, casual workers, and people on variable hours contracts. From April 2026, there is no earnings floor. An employee working 6 hours a week at minimum wage qualifies for SSP on the same basis as a full-time salaried employee. If your workforce includes part-time or variable hour staff and your payroll has not been updated to reflect their new SSP eligibility, you have a compliance gap that HMRC's enforcement activity is specifically targeting. Third, the payment calculation has changed. SSP is now capped at the lower of 80% of earnings or the SSP flat rate. For employees earning above the flat rate equivalent, the payment is the same as before. For lower-paid employees where 80% of their weekly earnings is less than the standard SSP flat rate, the payment is calculated at 80% of their earnings, rather than the flat rate. That means the SSP amount is now variable by employee income, rather than a single flat figure applied universally, which has implications for how your payroll software calculates and records SSP payments. If your software has not been updated to apply the 80% of earnings calculation where applicable, some of your SSP payments may be calculated at the wrong amount. Employers should ensure payroll systems are fully aligned with the new rules, review sickness absence policies, and familiarize themselves with HMRC's transitional guidance. If that review has not yet happened, August payroll is the point at which any miscalculation from April onwards may surface in an HMRC compliance check. The second change I want to cover is the one that starts in August 2026, and that will generate questions from your employees, questions that your HR team and payroll function need to be prepared for. From August 2026, HMRC will be contacting around 1 million eligible individuals directly about the low earners pension payment, previously referred to as the low earners anomaly. This payment makes sure low earners achieve similar outcomes regardless of the type of workplace pension scheme they are in. Employers do not need to take any action. There is no requirement for employers or payroll teams to apply, assess eligibility, amend payroll records, or contact HMRC on behalf of employees. HMRC will identify eligible individuals and contact them directly. Here is what the low earners pension payment is and why it matters. In most workplace pension schemes, the pension provider claims basic rate income tax relief on contributions and adds it to the pension pot, a system called relief at source. For basic rate taxpayers, this works as intended, but for employees who earn below the
personal allowance of £12,570, meaning they pay no income tax at all, this relief was never available in the same way because there was no income tax paid to be relieved. An employee may be eligible if they did not obtain income tax relief on their pension contributions in any tax year from 2024 to 2025 onwards. This would be if they earned close to the personal allowance in a tax year, typically £12,570, and contributed to a workplace pension that uses the net pay arrangement rather than relief at source. HMRC is now contacting those individuals directly and making a payment to correct this anomaly. The payments will begin landing from August 2026. Your employees will receive letters or communications from HMRC explaining what the payment is and why they have received it. Many of them will not understand the letter. Some will assume it is a scam. Some will bring it to you or your HR team to ask what it means. The correct response from an employer perspective is to confirm to any employee who asks that this is a genuine HMRC communication, that it relates to pension tax relief they were entitled to but did not receive, and that no action is required from them or from the business. The payment is being made directly by HMRC. Your payroll records do not need to change. The employee does not need to ring HMRC to claim anything. The letter is the notification, and the payment will follow according to HMRC's own schedule. Drop a comment below if you are an employer or payroll manager and this is the first you have heard of this exercise. HMRC published it quietly in the June Bulletin, and the number of businesses that have not yet briefed their HR teams on what to expect is significant. Back to the compliance issues HMRC flagged most prominently. HMRC reconciliation failures also occur where full payment submission fields are completed incorrectly. The April 2026 Employer Bulletin identified a specific set of full payment submission errors that HMRC is seeing
repeatedly across employer payrolls, and that are generating incorrect employment records in HMRC systems, triggering wrong tax codes for employees, and creating reconciliation failures that then require manual correction by HMRC and the employer together. The most common errors HMRC identified are these. This typically occurs when the indicator is not ticked or when the old payroll ID is not provided. When this happens, HMRC systems treat the new payroll ID as a new employment, which leads to errors. Errors also occur when employers submit a start date or a starter declaration instead of using the payroll ID change indicator. This causes HMRC systems to treat the update as a new job, which creates a second employment record for the same employee. In plain terms, when an employee's payroll reference changes, for example because of a payroll system migration, a restructure, or an internal administrative change, the full payment submission must use the payroll ID change indicator to signal to HMRC that this is the same employee under a new reference, not a new employee, not a new employment. The same person, same job, new ID. If that indicator is not used correctly, HMRC system creates a second employment record alongside the original, which then generates a wrong tax code for the employee, often putting them onto an emergency basis code that overtaxes them until the error is corrected. A genuine new employment must include a start date, as missing start dates can cause HMRC systems to merge separate employments. Incorrect completion of taxable pay fields is another cause of errors, especially when taxable pay in the period is submitted as nil, while taxable pay to date is completed. This can result in merged or incorrect employment records. The practical implication for your August payroll is to review the full payment submissions your payroll software is generating and confirm that the correct indicators are being used for payroll ID changes, that start
dates are present on all new employment records, and that the taxable pay in the period field is never submitted as nil when taxable pay to date is a non-zero figure. These are not complex checks, but they are checks that need to happen at the payroll submission stage, not after HMRC has generated wrong tax codes and your employees are asking why their take-home pay has dropped. The third major change that employers need to be preparing for now, even though the mandatory date is April 2027, is the move to mandatory payrolling of benefits in kind. The requirement to report non-cash benefits via the payroll will start to become mandatory from the 6th of April 2027 with a phased approach, removing the requirement for P11D reporting, with income tax as well as Class 1A national insurance contributions collected via the payroll every pay period. HMRC announced the phased approach in June 2026, with further guidance expected during summer 2026. It is expected that employers who wish to start payrolling certain non-mandatory benefits 1 year earlier will be able to register with HMRC prior to the end of the 2026 to 2027 tax year by the 5th of April 2027. What this means in concrete terms is that the annual P11D form, the document employers currently use to report benefits in kind such as company cars, private medical insurance, and other non-cash benefits provided to employees, will be abolished from April 2027. Instead of reporting those benefits annually on a P11D after the tax year ends, employers will be required to run the benefit value through the payroll in real time every pay period, collecting the income tax and Class 1A national insurance monthly rather than annually. The implications for payroll preparation are significant. Every benefit in kind your business currently reports on a P11D will need to be valued, coded into your payroll system, and run through payroll monthly from April 2027. For company cars, where the benefit in kind value depends on
the list price, the CO2 emissions band, the fuel type, and the employee's personal tax position, that calculation needs to be embedded in the payroll run rather than handled separately at year-end. For private medical insurance, where premiums fluctuate and the benefit value changes with policy renewals, the same applies. From April 2026, reimbursements for eye tests, flu jabs, and home working equipment will be exempt from income tax, aligning the treatment with direct employer provision. That exemption reduces the number of items that need to go through benefits reporting for the 2026 to 2027 tax year, but it does not reduce the underlying complexity of moving everything else into the payroll from April 2027. Employers who begin reviewing their benefit structure and payroll software capabilities now are the ones who will make that transition without disruption. Employers who wait until April 2027 will be managing a significant change on a live payroll under time pressure. There is one more deadline from the June 2026 bulletin that some employers may have already missed, and the consequences of missing it are financial and immediate. For those employers who do not payroll expenses and benefits, the deadline for reporting P11D expenses and benefits in kind provided in the 2025 to 2026 tax year was the 6th of July 2026. Payment of Class 1A national insurance contributions must reach HMRC by the 19th of July 2026 if paying by check, or the 22nd of July 2026 if paying electronically. If your business provides benefits in kind to employees, company cars, private medical insurance, loans, living accommodation, or any other non-cash benefit, and you did not submit the P11D forms by the 6th of July and the P11DB by the same date, you are already in late filing territory. HMRC charges a penalty of £100 per 50 employees for each month or part month the return is late. The Class 1A NIC that was due by the 19th or 22nd of July is also now overdue and attracts
late payment interest at 7.75% from the day after the payment deadline. If this applies to your business, the correct action is to file the outstanding P11D and P11DB returns immediately through your payroll software or HMRC's PAYE online service and pay the outstanding Class 1A NIC as soon as possible to stop the interest accumulating. Filing late is a better position than not filing at all. Late returns can be submitted and late payment interest can be minimized by paying promptly, even if the deadline has passed. So here is the complete picture and what your August payroll run needs to reflect. Statutory sick pay changed on the 6th of April 2026. The 3-day waiting period is gone. The lower earnings limit is gone. Payment is now the lower of 80% of earnings or the flat rate. Every late payment interest at 7.75% from the day after the payment deadline. If this applies to your business, the correct action is to file the outstanding P11D and P11DB returns immediately through your payroll software or HMRC's PAYE online service and pay the outstanding Class 1A NIC as soon as possible to stop the interest accumulating. Filing late is a better position than not filing at all. Late returns can be submitted and late payment interest can be minimized by paying promptly, even if the deadline has passed. So here is the complete picture and what your August payroll run needs to reflect. Statutory sick pay changed on the 6th of April 2026. The 3-day waiting period is gone. The lower earnings limit is gone.
Payment is now the lower of 80% of earnings or the flat rate. Every employee is eligible from day one of sickness. Review your payroll system settings, your sickness absence policy, and your line manager guidance to confirm all three reflect the current rules. From August 2026, HMRC is contacting approximately 1 million employees directly about the low earners pension payment. No employer action is required. Brief your HR team and payroll contacts so they can field employee questions accurately when those letters arrive. Review your full payment submission process against the errors HMRC identified in the April bulletin. Payroll ID changes must use the change indicator, not a new employment start. New starters must have a start date, and taxable pay in the period must never be nil when taxable pay to date is non-zero. Begin preparing for mandatory payrolling of benefits in kind from April 2027. HMRC has confirmed the June 2026 phased approach, and further guidance is expected this summer. Employers who want to start voluntarily before April 2027 can register by the 1st of April 2027. Use the time between now and that date to map your current P11D benefits, review your payroll software capabilities, and understand what the monthly calculation and reporting process will look like for each benefit type. And if your P11D forms for 2025 to 2026 were not filed by the 6th of July, file them now and pay the outstanding Class 1A NIC immediately to stop interest accumulating further. HMRC does not send individual reminders to every employer before payroll deadlines pass. The bulletin is published, the obligations apply, the penalties run automatically. The employers who respond to this video by checking their August payroll against these points are the ones who stay compliant without a nudge letter from HMRC's enforcement team. Share this with any business owner or payroll manager you know. The SSP changes alone are catching businesses out 3 months after they came into force. Subscribe to HMRC Update if you are not already here.